Looks like everybody has arrived, so welcome and good afternoon, everyone, to APNM's webinar, Maximize Your Charitable Giving for Animals. I'm Dorothy Hutchinson. I'm the Chief Development Officer for APNM, and with me today is my co-host, Isabel Slater. She is APNM's Major Gifts Officer. And for those of you who may not be familiar with Animal Protection New Mexico, we are a statewide organization that protects animals by creating social change, resulting in the humane treatment of all animals. So we thank you for being here today and for your interest in learning about tech-savvy and cost-effective ways to support your favorite causes. We'll be going over 3 powerful giving mechanisms, and those are IRA distributions, gifts of stock, and donor-advised funds. And all right, from there, I'm super excited to introduce you to our wonderful speakers this afternoon. And today we have with us financial advisor Mark Napolin, longtime supporter Bill White, and Marisa Magallanez, Vice President of Strategy and Equity at the Albuquerque Community Foundation. So we thank you all for spending time with us today to share your expertise and your insight with our audience. And with that, I'm going to turn it over to Mark, who will get us started and take us through today's presentation. Thank you, Mark.
Good afternoon, everyone, and thank you for joining us. We've done several of these in the past, either live before COVID or several now that we've done through a webinar format. The prior ones were more complex topics dealing with gifts from your estate, which could also include trust type giving. We talked about charitable remainder trusts, charitable lead trust, and some of those advanced planning ideas regarding estate planning. They're still very valid ideas. In fact, they may even become more important now, those advanced techniques, because of the proposed tax changes that are going to be before Congress here not too soon. Some of them will make gifting this year even more valuable than gifting in future years. That could include gifting to your charities as well as gifting to your family members. And the main purpose of that would be to reduce the size of your taxable estate, because we are expecting the current exemption amount, which is over $11 million per person, to be reduced considerably, which will cause a lot more estates to be taxed. The current tax rate is 40% for estates. It's expected to go up to 45% or even higher. So giving to charities, giving to your family members to reduce that will be important going on. So 2021 should be a good year for gifting and planning. Although my firm does an awful lot of work in charitable gift planning, which I would call philanthropic planning, we also concentrate on retirement planning, which some of the topics today center around retirement planning. We're a privately owned firm headquartered in Albuquerque, but with clients throughout the Southwest. Also, I would expect higher capital gains rates going forward in the future, and potentially, and this is the scary one, a loss of what is called step up in cost basis. And I'll give you just a very quick example there. Let's suppose you bought your home for $100,000 in 1980, and at the time of your death, and this would easily apply to Santa Fe properties, your property has greatly appreciated and it's worth $800,000 when you pass away. Under current law, your heirs will inherit your home with a stepped up cost basis, and they will not pay capital gains on that difference between $100,000 and $800,000. So if this law becomes effective, your heirs could pay taxes on that capital gain, which you've deferred. The same would apply to stocks and other appreciated assets. So before I go to our presentation, I just wanted to say that this is a great year to meet with your financial advisors, your CPA, your attorney, and see how these new laws could potentially affect you and your family planning. The three topics for today are IRA distribution strategies, and we'll cover some of the tax efficient ways of distributing monies from your IRA. We'll talk about gifts of appreciated stock that have grown in value, and now you can gift those and have tax advantage. And then we'll close on donor advised funds. After my first presentation on IRA distribution strategies, a donor and long-term supporter of animal protection, Bill White, will give some of his insight on this. Well, IRAs, as you may or may not know, if you're over 72, you certainly know about this. But when you reach age 72, you must begin taking distributions from your IRA. It's required, and those required minimum distributions are fully taxable, and they're not taxed at capital gains rates. They are taxed at ordinary income rates. And you'll know that RMDs, these are required distributions, can also cause you to pay a Medicare surtax because it raises your income. We'll talk more about that later. Gifts to APNM or any of your other charities, and even though our focus today is Animal Protection New Mexico, any of our conversation will apply to all the charities that you love and want to help out. So you can deduct those gifts on your Form 1040 using the Schedule A. But it says in the little footnote there that deductions on the Schedule A may or may not offset the additional income from that RMD. So you're taking a distribution from your IRA and then you're taking a deduction on your Schedule A. It may not offset it. So we are going to talk about what is called a qualified charitable distribution, a QCD. That qualified charitable distribution requires that the distribution go directly to APNM. So when you're talking to your financial advisor or your custodian for your IRA, you have to specify that that check will go directly to APNM. If it comes to you, but it's made payable to APNM or payable to Red Cross or payable to your other charities, that's okay. You can deliver the check to your charity, but it can't go into there cannot be a 1099 issued to you for a regular distribution. It has to be under that qualified charitable distribution. This is the key point. It's excluded from your taxable income. You don't get a charitable deduction because the funds went directly to APNM. So it bypasses you. You don't claim the deduction on your 1040. You just don't pay income taxes on it. That's pretty straightforward. And again, if you have questions, put them in your Q&A box and we'll answer them at the end. The rules are you've got to be at least age 70 and a half. And earlier we talked about age 72 when the RMDs must begin. The law was changed a couple of years ago. So you used to have to take them at age 70 and a half. Now you can push it out to age 72. And last year, because of COVID, a lot of people they had their required distribution waived and did not have to take a required distribution last year. And that was good because the market tanked at the beginning of the year and people didn't want to be taking distributions from their IRAs with the market values down. I'm going to let my dog in the room. Jack was getting antsy. He's going to go ahead and lay down in the corner and be a good boy. Okay, Jack, lay down. So you have to be at least 70 and a half. You can gift up to $100,000 directly to your charities. And if you're married, it's actually up to $200,000. You can't write a check. It has to go directly to Animal Protection New Mexico. Maybe some of you have received an IRA as an inherited IRA, which is also called a beneficiary IRA, or one of your loved ones has left you an IRA. You can make distributions, qualified charitable distributions from that, as long as the beneficiary is at least 70 and a half years old. One thing that I want to point out, if you do this strategy, on the form that you get, from your IRA custodian. And that IRA custodian could be your brokerage firm, it could be a bank, it could be a trust company, an asset management company. Our firm, when we sit down with people, we want to make sure that the proper name of the charity is specifically indicated, because charities will have multiple organizations maybe throughout the country. So if you want, let's say it's a national charity, but you want it to favor your local chapter, you've got to be very specific. You need the tax ID number for purposes of that charity, as well as their address. We had a client a few years ago who, and I'll just give you an idea here. He was a Santa Fe guy, a founder of a well-known business. He had a miscellaneous IRA they had frankly forgotten about. And he was a pretty wealthy guy, so he did not need the money. So what he did every year, and this is before the QCD rules even came out, he just made an annual distribution of his RMD to a foundation. And it was about a $250,000, $300,000 IRA. He took that annual distribution and he contributed to his foundation. And the foundation bought almost a $1.5 million life insurance policy in his life. He passed away a few years ago, and the foundation received $1.5 million. And that was from about a $250,000 amount. Some of the benefits of the qualified charitable distribution is it keeps your income taxes lower. It could reduce your taxation on Social Security. So it's all based on your adjusted gross income. And if your adjusted gross income is high, you'll pay more taxes on your Social Security. And you know, New Mexico is one of the states that does tax your Social Security. By keeping your income lower, so if the distribution check is not going to you, it's going to your charity, it does not increase your adjusted gross income. So it keeps your Medicare Part B and Part D premiums lower. As an example, if you're a single person and you make about $88,000 or less in total income, then you're not charged an extra premium for your Medicare. If you make over $88,000 as a single, then you're going to pay a higher Medicare surtax. It can get actually as high as over $500 a month in Medicare premiums. The same with Part D for your prescription drugs. If you're married, you want to try to keep your income below $176,000. So by keeping these required distributions out of your adjusted gross income, it'll help save your Medicare. It will also potentially reduce your taxation of capital gains and qualified dividends, because again, your adjusted gross income will create a higher capital gains rate. There's 3 brackets for capital gains. The first one for lower income people is 0%. The next bracket is 15%. And for higher wage earners, the capital gains rate is 20%. So by keeping these distributions out of your adjusted gross income, you'll potentially pay lower taxes. It also lowers your AGI for Schedule A medical expense deduction. So most people who are retired, they'll have a Medicare supplemental, but there's many things that Medicare doesn't cover. For example, it doesn't cover home health care and other expenses that are deductible expenses, but your Medicare just doesn't cover them. So it keeps your AGI lower so you can get a bigger deduction on your 1040. Tax credits may not be affected as well because they don't affect your AGI is lower. And of course, state income taxes will be lower as well. At this point, I'd like to also mention that many donors today are not able to deduct their charitable contributions because they're using the standard deduction. You know, the standard deduction was increased a couple of years ago to over $12,000 per person. This year, it's $12,550 per person. And if you're a married couple, the standard deduction is $25,100. And if you're over 65, you can add an additional $1,350 for your standard deduction per person. So here's my point. let's say you write a check to your charities for $500, and you do it to 5 different charities. You've got $2,500 of charitable distributions that you've made or charitable donations you've made, but you don't really have a mortgage anymore. You don't really have any medical expenses anymore. And so therefore you take the standard deduction, which is either $12,500 or $25,000. That means you can't deduct your charitable donations. So using this QCD will enable you to you don't pay taxes on that distribution. And it's a great way for people who are using the standard deduction to make their contributions. And another rule that came out, if you're not an itemizer, you're allowed to deduct only $300 of your charitable expenses. So the QCD is a great way of doing it. Here's an example. I have an IRA that's valued on December 31st of 2020 of $250,000. At age 72, there's a factor based on your age. That factor is 25.6. So you divide your 250,000 by the 25.6, and therefore your RMD for 2021 would be 9,766. That's the minimum you must take. You can take more, but that's your minimum. So some sample gift ideas. Have your qualified charitable distribution, 3,000 go to APNM. I like the Sierra Club, $2,000. And I also like UNM Foundation, but it could be any number of charities. And it doesn't have to be $1,000, it could be $100. But there's some money left over. So I just said, well, let's take the kids to Hawaii. And we might have to be cheap at 3,766, but we'll take everybody to Hawaii. I want to give an example though. This factor at age 72 is 25.6. At age 80, that factor is 18.7. So it increases your RMD to 13,369 at age 80. So your RMD factor, the divisor, becomes less as you get older, meaning you have to take out more. By the way, this RMD, you don't have to worry about the calculation. Your IRA custodian will determine that for you and send you a calculation to tell you how much you have to take out. If you don't take out the required distribution, there's a 50% tax penalty. So it's best to get it set up on an automatic distribution. A question came up the other day. So let's suppose you have one IRA at Fidelity, you've got another one at Vanguard, and you've got another one with a trustee. Well, they don't know what the other one's doing. So they'll tell you what their required minimum distribution is. But let's say IRA number one was up in value quite a bit on December 31st. IRA number two, it might have been a managed account and it was, let's say, kind of flat or didn't increase in value. But IRA number three was down in value because some of the stocks that you had got beat up in 2020 and didn't recover. Well, you don't want to take an IRA distribution across the board from all of those. You probably wouldn't want to take any from the one that was down in value. So in our firm, what we do is help people that have diverse IRAs to choose the best place to take their required distribution from. And that can change from year to year. Our next category is donating stock directly to Animal Protection of New Mexico or to any other charity. The easiest thing about it, it's just simple and easy. In fact, all of these ideas we're discussing today, the reason we chose them, they are simple and easy ways to give. And distribution of stock to your charities is much more tax efficient than cash gifts. And we'll see that later in an example. You get a tax deduction for the full fair market value. Not the value you bought the stock at, but the value of the stock today. So if you gift that stock directly to APNM, it avoids federal and state long-term capital gains. The top capital gains rate today is 20%, plus higher wage earners and higher people with higher adjusted gross incomes. They pay a Medicare surtax of 3.8%, plus New Mexico, and New Mexico's raised its income taxes and capital gains rates as well. So by donating that directly to APNM or your other charities, you avoid the capital gains. The donor, you need to contact your broker or whoever is holding those stocks for you for a stock donation form. It's very easy to complete. And then you report that stock donation on a form 8283. Your CPA, your financial advisors can help you with all of that. Now, APNM and most charities do have a stock brokerage account. APNM has one. And so your stock gift would go directly to APNM. They would put it in their stock account, and the investment firm managing the funds would sell that stock and reallocate the money in the portfolio. Occasionally, they may want to hold on to a stock, but that's the prerogative of APNM and their broker. A couple of simple ideas on how to use stock donations. You could fill pledges to APNM campaigns, such as Animals and Architecture. If you've made let's say, a campaign pledge to your university or to a hospital, or wherever you've made a pledge, you can use the stock donations to meet and fulfill that pledge. End of year giving is a great way to do it. So you might be cash strapped, but you've got a stock that's been sitting there for years. It's grown in value. There's a lot of capital gains. You could give that stock to meet your gift, and it's less painful than writing checks. The last one is portfolio rebalancing. I'll give you an example there. Let's suppose you're a retiree and your ideal allocation with your assets would be 60% in equities or stocks and 40% in bonds or fixed income. Kind of a middle of the road, moderate type of a portfolio. But because some of the stocks that you were holding in your portfolio grew quite a bit in value this last year and the last couple of years, perhaps the stocks now have become valued at 70%. What a lot of people will do normally is they'll sell stocks, they'll have to pay the capital gains on that, and then they will reallocate that extra amount to the bonds so they can keep their portfolio in balance at 60-40. So what you could do is to trim off some of those appreciated stocks and gift those to APNM and your other charities, therefore avoiding the capital gains. When you donate the stock to APNM, it becomes an asset of APNM. It's on their books. The donation is recorded at the full market value of the stock, not the original purchase price, but the the current fair market value of the stock. I've got a simple example here. We have a lot of clients that love Apple stock. And what I'm assuming here is a $10,000 donation to your charity. APNM receives $10,000 worth of Apple stock. You're in a 25% overall tax bracket. If the purchase price of the Apple stock was $100 and it's trading now at $130 per share, you would gift approximately 77 of those shares to give APNM $10,000. You would avoid the capital gains tax of $2,300. Again, that's 20% in the federal capital gains rate, plus the 3.8% plus New Mexico. It actually could be greater than $2,300 that you save by giving it directly to APNM. Plus, of course, you receive a tax deduction for the full $10,000, which would save you about $2,500 in taxable gain in an itemized deduction. Pretty straightforward, easy example. I'm the investment committee I'm on the investment committee for a charity, and the charity requires annual dues. It's a religious organization. They require annual dues, And we see a number of people each year gift stock to meet their annual dues requirement. Again, it's not as painful as writing out personal checks. Again, any questions, put them in the Q&A. Our next topic is one that is the DonorAdvised Funds. And I do want to apologize. I did forget to include Bill when we were talking about the qualified charitable distributions. And I think what I'll do with your permission, Bill, is bring you in at the end when we're talking about, when we finish up the DonorAdvised Fund section. We'll have Marisa give some brief commentary along with you. We'll have you go first. And my apologies for doing that.
Not a problem. You're doing very well.
Okay. The APNM on these donor-advised funds, and I want you to know straight up front, donor-advised funds are just not for wealthy people. They're for regular people like you and me who have some money that want to set up a fund in their family name. And APNM partners here locally with the Albuquerque Community Foundation, with the Santa Fe Community Foundation, and with the New Mexico Community Foundation, where APNM and many, many other charities maintain funds. They are easy and far less costly and complex than private foundations. Kind of my rule of thumb on private foundations, because you have to have the legal documents, you have to have annual tax returns, you have to have pretty strict rules within those private foundations. I wouldn't want to do one for less than about $5 million. Some people will do them for less, and we're open to discussion on that. You can set up a donor-advised fund with a reasonable donation, starting with maybe $5,000. Some of the foundations will allow you to start with even a much smaller amount. And here locally, with the Albuquerque Community Foundation, Santa Fe, and New Mexico, we want to try to hit about $25,000 in the fund. And you have 5 years basically to get the money up to $25,000. The sponsoring organization handles all of the due diligence and record keeping, so you don't have to worry with it. Another strong reason by having that. There are some organizations where you can even start with $100. Fidelity has a donor-advised fund where you can actually start it with $100. It's the only thing I don't like about doing them out of state is you just don't have a local presence with your money. You can still achieve all the objectives, however. The logistics of that is that a separate account is maintained for each donor. When you do that, you're giving up complete legal control of the assets. In other words, they're not in your name anymore. They're in the name, let's just call it the Bill and Jane DonorAdvised Fund. The Bill and Jane DonorAdvised Fund now holds all those assets. As the donor, you advise the sponsoring organization, for example, your community foundation of your choice. You direct the sponsoring organization, you advise them where your charitable grant goes each year. So APNM and other nonprofits can be awarded those grants. It's very liberal. The donor, as it says here, advises the dollar amount, the timing, and the recipients. Very straightforward. I was talking to Marisa the other day, Marisa from the Community Foundation, and although these funds typically pay out about 4% each year of the fund balance to your charities, we have an endowment amount that you want to maintain in the account at all times, but amounts above that, you can make special awards, special grants. So during the pandemic, a lot of donor-advised funds made extra grants to needy organizations. It's very flexible. Marisa will talk maybe a little bit more about that. The donor sets the mission of their fund. It could be animal welfare organizations, healthcare organizations, veterans organizations, whatever. The other day I was talking to our group about a donor client of ours. They showed me their list of charities that they made donations to in 2020. It was about 5 pages long, single spaced. And I said, how in the heck do you manage that? The spouse looked at me and she said, it is a nightmare because they have to get gift receipts from every single one of those checks. Some of the checks were for $100. Several were in the few $1,000 range, but managing that is very difficult. So this way, you get one gift receipt each year for your donation to your DonorAdvise Fund. And that was attractive to them. And I asked them the organizations they wanted to give to. They were very heavy veteran focused, but they also said animals. So I'm going to have a private meeting with them and bring Dorte and Isabel over to their house and meet them, and maybe we can get a nice one, a nice gift. The donor can name successor advisors. In this example I just gave you, we would name their daughter as the successor advisor and their grandchildren. And if not, there's a trustee that could step in and advise their funds. So it could be essentially a gift in perpetuity. The tax benefits, and by the way, these tax benefits would apply to all of the giving that we've talked about. Cash gets the most favorable deduction. You can deduct it up to 60% of your adjusted gross income. So let's suppose you had adjusted gross income of $100,000 as a family, and you wanted to make cash gifts to a bunch of your charities. Well, you could actually gift up to 60% of your adjusted gross income, or $60,000 in that example, and it would be fully deductible. If it's appreciated property, whether it is stock or whether it is appreciated property, whatever, that's deductible up to 30% of your adjusted gross income. You can carry over that excess for 5 years. So let's suppose that your gift exceeded 30% of your adjusted gross income because you made a large gift. You can carry that forward on your tax return for 5 years. What we like about the concept of the DonorAdvise Fund, you can deduct it now. So let's suppose you make a direct gift of $25,000, $50,000, whatever, to your DonorAdvise Fund. You can take a full deduction now in the year that you made the gift, and you can donate later. You can make the donation in a year that you're having higher income, take that deduction now, and you can, if you want, delay the charitable grant until later on. So it's, again, a very, very flexible tool. The other comments I want to make about the DonorAdvise Fund is you can contribute more unusual assets, such as real estate, limited partnerships, even closely held business shares. An example of real estate. Now, every charity like the Albuquerque Community Foundation, Santa Fe, New Mexico Foundation, UNM Foundation, they all have what they call gift acceptance policies. If the piece of real estate, let's say you're gifting, is an old gas station that's been abandoned and you owned that for many years and it's vacant, well, the charitable foundation may not want to accept that because of the potential issues related to environmental concerns. However, if it's, let's say it's a commercial building, the charity would probably say in that DonorAdvise Fund, we will sell that piece of real estate, we'll take the proceeds and put them into your DonorAdvise Fund. So again, it avoids all the capital gains on that real estate. Limited partnership interests. Many people have small limited partnership interests and they want to get rid of those. They don't want to hold them anymore. Or closely held business stock. Let's say you were the founder of a New Mexico-based company. You could actually gift those shares in your company. Again, the charity doesn't want to own those. The DonorAdvise Fund doesn't want to own those stocks or those partnership interests, or those shares in your private company. So they will actually, in most cases, make an agreement to sell those shares back to the general partnership or back to the closely held business, because the partners don't want a charity owning their stock or partnership interests or your business shares, so they'll buy them back. You need to talk to your attorney on those types of more sophisticated transactions. The donor advised fund clearly has lower expenses. The expenses are kept very low. There is privacy of your donation. You can actually have an anonymous fund if you wish. There's an indefinite lifespan. So when you've passed away, that donor advised fund will continue. So if you've been gifting, let's say $1,000 a year to APNM or the Red Cross, and you set a $25,000 endowment, and if you put a $25,000 endowment in place, that will perpetuate your gift to your charities. And obviously it instills family values. You can get your children, your spouse, other family members involved today, and you can really enjoy today the value of that charitable giving. I want to quickly look at our time. We do have some time available now for, let's have you go first, Bill, to talk about how you and your family have benefited from the qualified charitable distribution, the QCD.
Sure, Mark, thank you. I and the woman I am lucky to be married to, Ann Collar, who is on the board of APNM, are animal people and have supported Animal Protection New Mexico and animal protection voters, as well as other animal-related entities and projects since well before we moved to Santa Fe 16 years ago. We moved to Santa Fe with 3 shelter dogs, Ernie, AKA Yellow Dog, Bridget, Scaredy Cat Dog, and Miss Sophie, Mama Dog, who always considers herself to be socially above the riffraff with whom she graciously lived. Millie Dog who is behind me, is an Espanola purebred who agreed to allow us to adopt her after Scaredy Cat, Yellow Dog, and Mama Dog went to doggy heaven. Millie is now 10 and a half, has everything under control in our home, and is much more intelligent than I will ever be. In fact, she is behind me on the couch to be certain that I don't stray from these talking points. Ann and I give financially to APNM and other qualified charities through our IRA, as Mark said, to reduce our taxable income as compared to the taxes we would pay had we taken our required minimum distribution in cash and donated that cash to qualified charitable entities. I'm on the panel to walk you through what Annie and I consider to be the very easy process of giving directly from an IRA to a qualified charitable entity, such as APNM. First, let me be clear that you understand I'm not a tax professional, nor am I an attorney. I'm just an ordinary guy who has been advised by our CPA that we can save substantial tax dollars if we gift qualified charitable organizations directly from our IRA. Importantly, when you choose to gift directly from your IRA, you should discuss your expected annual giving amounts with your financial advisor, such as Mark, at least on an annual basis, so they can be prepared. Your advisor will then have sufficient cash liquidity in the IRA to comply with your gift requests without having to unexpectedly sell assets to comply. At that point, your financial advisor will walk you through how they want you to make those requests. In our situation, the process is very simple. When we want to make a gift to, for example, Animal Protection New Mexico, all we do is send an email to our advisor with the following information: the amount of the gift that we would like to make. We request that a check be payable to Animal Protection of New Mexico with their tax ID number. And we request that the check is sent to our address of record, sent to us here at the house. It's important that the check be made payable to Animal Protection, as Mark said, and sent directly to us. No wire transfer, no ACH transfer, After receipt, we either mail or hand deliver the check to Animal Protection in this example, with a cover letter identifying who we are and our mailing address. The cover letter explains that we want the required tax letter sent to us by Animal Protection of New Mexico for our tax records. We got to have that support. This process is very important as a check, wire transfer, or ACH transfer payable and sent to a qualified charity directly from the IRA by our administrator does not identify us as the donor. Animal Protection in this example would have no idea as to whom the donor is. It's really easy. Every dollar you get from your IRA up to $100,000, 200,000 jointly, is not taxable by the IRS. As Mark said, if you take the cash distribution from your IRA, then make the contribution to a qualified charity, you will owe income taxes on the amount of that distribution. True, you may deduct the amount of the gift if you itemize, but you will still pay more in taxes to Uncle Sam if you do it that way. Thanks for your participation. I'll be available for questions at the end of the presentation.
Great, thank you, Bill. Great job. Very concise. Again, if you have more questions, we have several questions in the queue. But before we go to the questions and answer, I'm going to introduce Marisa, who is one of the development people at Animal Protection, at the Albuquerque Community Foundation. Marisa, if you could briefly introduce yourself and maybe give some additional input for our audience.
Yeah, thanks, Mark. It's a pleasure to be on this panel today with Dorothea and Bill and Mark. We're happy to be supporters of APNM and just grateful for Mark and all of your contributions to the Community Foundation. So grateful to be here, although I will let you know that my greatest joy is spending time with my dog and horses. There's nothing more that brings me joy than combining those two activities. So big supporter of this work as well. I wanted to share, Mark is an expert and laid out some beautiful information on donor advised funds, but I wanted to talk a little bit more about something he said at the very beginning, which is reiterating the accessibility and the flexibility and the ease of donor advised funds. So I'll just hit on a couple of points and then some anecdotes. First, the Community Foundation, this is one of the vehicles that we work with the most. And I wanted to talk a little bit about the process. It is such an easy process to set up a donor advised fund. We love working with donors on your timelines. So if it's something that you need to do by year's end, and there's a pressure to set that up quickly before 12/31, we've turned around donor advised funds in a matter of 48 hours, get them set up quick. If it's something that you're taking your time and working with your financial planner, we're happy to guide and be part of the process with you along the road. Mark mentioned the grant making process in his and the distributions in his slides, and I wanted to just talk a little bit about that from a due diligence perspective. As the Community Foundation, we take the stewardship of the assets and the due diligence process of the grants we make very, very seriously. It's core to our certification as a nationally certified community foundation. And some of the things, there's two really fundamental pieces that of due diligence that we conduct for every grant that goes out of the Community Foundation. One is we make sure that that Community Foundation is in good standing. And two, we make sure that that 501c3 is in good standing. And second, we make sure that it is not an organization that is listed as a hate group on the Southern Poverty Law Center. And those are the two pieces of due diligence that we conduct on every grant that comes out of the Community Foundation. I'm going to move a little bit and talk about one of my favorite top types of donor advised funds. And really thinking about this from the viewpoint of accessibility. We have a fund, a way to build a donor advised fund that we call Now and Forever. And we love this fund, and we use it all the time at the Community Foundation because we're working with donors who want to set up an endowment, a donor advised fund, but they also are very much giving actively in their community now. And again, especially as Mark mentioned, these last few, 14, 16 months or so, we've been living in an extraordinary time, and folks are seeing the need today. And so we created a way to develop a donor advised fund that we call the Now and Forever Fund. And we love this because it combines the idea of donors being able to grant out funds today and do their giving actively today. And then it takes the other half of their money. So for example, if they're giving $5,000 a year, 2,500 of that goes out into community to charities that they love to support. And the other 2,500 we use to start seeding that donor advised fund. And so what donors love about the flexibility of this is that they know their funds are going out to organizations now when they need it most, but they're also tucking funds away to start to build that donor advised fund. The last thing I'll say is really about the power of endowment, the power, Mark again hit on the indefinite lifespan. And I want to just share a fund. It's an old fund. It was established in 1988. So just about 7 years after this community foundation was established. We're in our 40th anniversary this year. So this fund is 33 years old, and it was established with quite a large gift, a $2 million gift. But in its 33 years, this fund has granted out $3.7 million. So more than it started with its initial balance. And the current balance of this fund today is $5.2 million. So I'll end with that, just sharing about, we're so fortunate at the Albuquerque Community Foundation to see the longevity, the lifespan of these funds. And again, our joy is being able to steward those assets, work with donors to meet their philanthropic goals, and to see incredible funds like this far exceed the seed that they were planted with, and make such a huge impact in the community. So thanks so much, everybody, for having me here today. It's been a pleasure to share a few anecdotes from the Albuquerque Community Foundation.
Excellent summary, Marisa. Good job. And all of our foundations here in New Mexico that can support donor advised funds, they have similar philosophies and have the same level of due diligence of your funds. So that was a great recap. I'll give one story, and you may be familiar with this one, Marisa. Many years ago, remember that nice restaurant that used to be in Albuquerque called Stevens Restaurant? This is probably before your time, Marisa, but there was a beautiful restaurant, and Stevens hosted a dinner for the United Rural College, and they had attracted a number of potential donors, and I was one of the speakers at that dinner, and I invited several guests, and one of the guests, when they left, they wanted to support Polish students that were going to be attending the United Rural College by giving them a scholarship. And they made a gift, a donor advised fund, which is a very nice fund today, which continues to support these Polish students after probably 30 years. So, the husband has passed away, the wife is still active, but I know the children will continue that mission for the United Rural College. I would like now to answer some questions that have come up. Just a minute, please. My car key? Yeah, I do, yeah. Oh, sorry. Sorry, folks, be right back with you. Little logistics here in the office. The questions that we've received so far, there are 4 questions, and you can pipe in with some additional questions if they come up. The first question, with the donor advised fund, does the community foundation manage the portfolio? Are the funds that the funds are invested in? Does the donor have any input on the investments chosen? Well, the answer is depends on the donor advised fund. So if you have a donor advised fund, and depending upon the size of the fund, in most cases, the community foundation will put your money in with the other, they have an investment advisor for the foundation, and that your monies will be mixed in with everybody else's funds. So they have professional third-party money managers that report to an investment committee at the community foundation. The community foundation then monitors those investments. They have a fiduciary responsibility to manage those investments at a low cost to keep them consistent with the overall investment objective of the foundation. And to answer your question, even a little bit more detail, those are professionally managed. The investment returns historically have been good with most of these foundations, and the fees, because of the size of the volume that we're dealing with, which in most cases, is $100 million or more, the fees are very reduced. There are, however, possible for donors who have larger funds to be able to direct those investments. Now, our office manages some donor advised funds for people where they have 100% say on how those monies are invested, and so does Fidelity Investments and other donor advised funds. But if you want to keep it with a community foundation, you turn over, in most cases, the investment decisions towards the fund. Another question, with a donor advised fund, can the donor deposit more in the donor advised fund than is distributed in any one year? Yes. So let's take an example. There was a $25,000 endowment that was established, and we heard from our earlier commentary that 4% or $1,000 would be distributed. Well, that donor wants more money to be distributed from the donor advised funds, so they would make some additional contributions to that donor advised fund. And although there might be some rules depending upon the fund, that's a way to get more money out to your charities. Marisa, was there anything that I mentioned on those two that you would want to add on those two questions about the donor putting in more money to make more distributions, for example?
I didn't want to add anything to that. I wanted to actually add one thing to the first question about the investments chosen. And that's just to share something that we're seeing happening nationally with community foundations, is to develop investment pools that donors can elect to put their funds into that are socially responsible. And so that is a growing trend. It's something that we're just starting to look into at the Albuquerque Community Foundation as well, and would give donors some option within the Community Foundation managed investment pool. So I just wanted to add that to question number one.
Good comment, yeah.
Thanks,
And what
Mark.
we've seen on the socially responsible investments with our clients is that the performance has not been jeopardized by investing in socially responsible companies. So that was a good point, Marisa. Another question came up. So you've passed away, you're gone, and how would that donor advised fund, how could you fund that after your death? Could you do it through your trust? Well, let's talk about that. Your trust could have provisions, and again, I'm not a lawyer, so you'll want to consult with your personal attorney, but if you don't have a trust, let's just say you have a will, you could direct in your will that additional distributions could be made, or funds given to your favorite charities or to your donor advised fund upon your death. So that would be a bequest in your will. And Isabel has a document where you can make those kinds of bequests directly to either APNM, or your other charities will have bequest forms as well that can be done after you pass away. So let's suppose that you have a trust, and it's a revocable living trust, what is legally called an inter vivos trust, which is a very common type of trust. Husband and wife, or a solo donor, a grantor of the trust. They are the trustee during their lifetime, but when they pass away, the trust continues, and there's a successor trustee that manages that fund. Depending upon the language in that trust, yes, there could be additional funding directly to your charities or to your donor advised fund. And it's a way of perpetuating your gift. We've seen this in large charitable contributions made through a will or a trust. We've also seen it through specific trusts that come into place upon death. I'm reminded of the Jackie Onassis Trust. She set up a lead trust where her charities got distributions for many years after her death. And then finally, ultimately, the balance of those funds after maybe 20 years or so would go to her children. Now her daughter Carolyn is the recipient of those funds. So it's a way to take care of your charities after your death, as well as benefiting your children. Another question came up about recommendations how to choose an entity for the donor advised fund. Should it be the Albuquerque Community Foundation, Santa Fe, New Mexico Foundation, UNM Foundation, wherever? Well, and let's suppose you had a very specific, very driven interest in providing for your university. And you didn't care about animal protection, you didn't care about Red Cross, you wanted to benefit your university. Well, you could set up a donor advised fund at your university that would specifically benefit your causes at that university. Now you've pretty much limited yourself to that university in that example. You could also pick a donor advised fund at the American Red Cross. And again, your distributions to the American Red Cross would be exclusive for Red Cross projects. Again, your family could advise on that upon your death. The nice thing about using a community foundation is that you have the flexibility to donate to other organizations outside of that university or the Red Cross or the hospital or whatever. So I like using a donor advised fund that is more flexible. And again, you could also use other privately invested donor advised funds through Fidelity and other investment managers. Well, are there any additional questions that you would like to ask now before our time is almost up? Let me see if there's any additional questions that have popped up.
It looks like there is, Mark. This is Isabel.
Let me scroll down.
Yeah.
There's one more.
Any downsides to the donor advised fund? It's an irrevocable gift, so you have no control. If you establish an endowment, let's just use an example. You put in $100,000 and you establish $50,000 as an endowment amount. That endowment amount, you can make 4% distributions in most cases. Donor advised funds are different across the country, but you would be limited to the amount that you could give from that endowment fund because you've made an agreement to keep it at $50,000. But the other $50,000 that you had in your donor advised fund, which is not restricted, you could be a lot more flexible on that. As Marisa said earlier, you could make a donation above and beyond the 4%. You could actually spend down that $50,000, that extra $50,000 to your other charities based upon specific needs that they may have. So the downside is you've tied it up. The money is invested by the investment committee at the foundation. You virtually have no say on those investments unless it, again, is one of the privately managed donor advised funds. And you are limited as to how much. So if it was all in endowment, you could only give away, let's say, 4% per year. But being flexible, maybe setting the endowment at an amount that would produce at $50,000, that would be $2,000 a year of endowment gifts, grants being made from the endowment, but the other $50,000 in that case would be flexible. Again, you don't have to start with $50,000 or $100,000. You can start in most cases with much, much less money. Some do require, the ones that are very privately managed donor advised funds with private asset managers, they typically will require about $100,000. And then you have say-so on the investments. You have a lot more flexibility in those cases. These are all three great ideas. In summary, we talked today about the qualified charitable distribution and how easy that is to do. In fact, this year, when I do my charitable gifts, I won't have to be receiving 10 or 15 different charitable gift receipts. I'll get one. That'll be perfect. And then also when I do my, and you can do it for $100. It doesn't have to be thousands of dollars. Then also the other one we talked about is gifts of appreciated stock. And I've seen a lot of those this year, especially with so much appreciation in stocks like Apple and others where people have very, very low cost basis in those, and it avoids the capital gains and keeps your adjusted gross income much lower. And the third one, of course, the DonorAdvised Funds. They're all very flexible. If you have questions, you should call Dorothea and Isabel on these, and I'm always happy to consult, and there's no charge for just answering questions and talking to you all. I'll turn it back to you, Isabel and Dorothea, for any closing comments.
Yes, thank you, Mark, and thank you, everybody, for this great information. We did receive one other question from a donor who is unable to join today, but would like to receive the recording. So what she's interested in is, and her question says, does the recipient of the donation incur a tax when they liquidate the stock? And
Okay,
obviously
I'll
it's
answer
about
that
stock
one.
donations.
If I understood the question properly, you gift that $10,000 of Apple stock to
Yes.
Animal Protection New Mexico, which is a 501c3 tax-exempt organization. So the capital gains tax, when it is sold at APNM or your other charities, there's no capital gains tax because of the nonprofit status. I also want to make a point now for those, because we're talking about APNM, there's also animal protection voters, and you will not receive a tax deduction on gifts because it is not a 501c3. It must be a 501c3 in order to get the deduction. Did that answer the question properly?
I'm
Dorothea?
sure it did, and we will pass on the answer to our supporter, and then if she has more questions, we will direct her toward you.
Again, I want to repeat, many of these are, I'm giving general information. Many of these, because of your specific situation, you must discuss with your CPA and or your attorney, because some of these get into more complex, and they're based on your personal financial position and your tax situation. Thank you. I will sign off. If there's any other questions, you can pose them to me directly. My contact information is on the screen there, or get back to Dorothea or Isabel, and they will inform me of the questions.
Absolutely. Thank you so much to Mark, Bill, and Marisa for sharing such incredibly valuable information with us this afternoon. And thank you to you all for taking the time to be here with us today. We recorded the session, and we will make the recording available to everyone. And we hope you have a great evening. Thank you.